business school, and Benjamin Junge, a former PhD student who is now in a hedge fund in Paris. So maybe he is profiting from that. We don't know. But what we do in this paper is we look at a new or relatively new derivatives market, which is the market for credit default swap index options. And what we're interested in is extracting implied volatilities from these credit index default from these credit default swap options and compare these volatilities to volatilities extracted from equity markets. And so what I'll try to do is first give you some motivation why we think this is an interesting thing to do. I'll give you a little bit of background on this fairly new options market for those of you who are not familiar with it. And then I'll tell you about our structural model, and then how we calibrate it, and then what we find when we compare volatilities extracted from these credit default swap index options to those extracted from equity index options. So the motivation for this, as you know, is that there's a large literature on credit default swaps, and in particular on credit modeling in finance, and going back to the old Black-Scholes Merton theory. And in these structural models, essentially both the equity and the bond can be thought of as contingent claims on the same underlying asset value of the firm. So in these models, really both the equity and the bond, and related to credit default swap, it should be driven by the same factors. Now, initial so-called first generation models, direct applications of the Merton model, didn't do so well when calibrated to match historical, for example, historical default rates and loss rates. They tended to underpredict credit spreads. That was the so-called credit spread puzzle. But second generation models that essentially have richer features, they have stochastic volatility, and in particular, and jumps, and in particular, they calibrate also to match the equity option, in particular, match out of the money put prices. So these options essentially are much more successful in matching the level of credit spreads. Essentially, they have richer dynamics, and they're able to generate a larger crash premium that's consistent with equity options, and then it turns out that they do better at matching the level of credit spreads. And so, for example, in the recent AER paper, Collin-Dufresne and Veronesi argue that there's a good deal of integration in that if they infer, they calibrate such a structural model to equity option data, then the implied credit spreads seem to be quite consistent with historical data on credit spreads. Now, this notion of integration used here is quite a strong one. It's essentially saying that in these typical structural models, both bond and equity should be driven by the same factors, the risk factors that drive the underlying asset value. That's a pretty strict sense in which the notion of integration is used. Now, there is some debate, obviously, whether this strong notion of integration actually is consistent with the data. There are some papers that are more relying on factor analysis in the spirit, for example, of Farmer French, that find that we actually might need different factors to price the cross-section of bonds and the cross-section of equity. Now, it's not entirely clear why we might use different risk factors. It could be that there is some bond-specific illiquidity. So there's still some debate out there about whether we need these extra bond-specific factors. Now, what we do in this paper is we focus on volatilities, and we essentially look at whether equity implied volatilities extracted from equity options, whether these volatility, the level of volatility and the dynamics of volatilities extracted from equity options are consistent with the volatilities that we extract from credit options. And for that, we use essentially this new market on credit default swap index options. Now, what's interesting is that if you look at how these credit default swap index options are actually priced in the market convention is to essentially quote a credit spread implied volatility, where the assumption underlying the model that's used as a market convention, as a quoting tool, is essentially can be rationalized using a reduced form model, so an intensity-based model. That model is completely different and is not internally consistent with a standard Black-Scholes pricing model on the equity side, which is, of course, the model that we're all familiar with that's used on the equity side to quote prices of equity options. So one of the issues we encounter in this paper is when we want to compare the implied volatilities quoted from credit options and with those from equity options, we can't readily compare the two volatilities, the implied volatilities. They don't correspond to the same quantity. And so one of the contributions of our paper is to propose a structural model where we can use the same model that's internally consistent to price both the equity options and the credit default swap options. That way we can extract a quantity from both these prices that we can readily compare. In our model, it's going to be something like an asset value implied volatility. Asset value implied volatility extracted either from the credit option or from the equity option. And to give you a quick overview of what the model looks like, it's a very, I would say, very standard model. In the classic tradition of the structural models, we will have essentially an asset value process that's going to have both jumps and diffusion components, and it's one such process for every asset in the portfolio. We will assume that firms issue both short and long-term debt. We need that so we can match data on the term structure of credit spreads. So in that model, the individual firm equity is going to be similar to a call option. It's going to be a compound type option because there's two debt maturities, but in spirit, it's very similar to the Merton model. The bond will be priced similar to a Merton model as a risk-free bond minus a put. So the credit default swap, the credit default protection will be essentially akin to a put option on the underlying asset value. And then when we want to price options on the equity, those are going to be option on options or compound options. And the credit option, the option on the credit default swap will itself also be an option on a put, so also a compound option. So at the individual firm level, we will have very standard formulas to price both the equity, the debt, the credit default swap, the option on the credit default swap, and the option on the equity that will be similar to compound option formulas. Now, when we think about the index, then of course we have to take a portfolio of these underlying options of the equity. So the index value itself, the equity index and the bond index or the CDS index, will be portfolios of essentially options on the asset values. And in order to be able to get an explicit solution for the distribution of these indices, we will use the idea of Vasicek of the large homogeneous pool approach, where essentially we approximate the portfolio to be a very large portfolio. And using that idea, we will get an explicit solution for the distribution of the index, both on the credit default side and on the equity side. And that distribution that we then know allows us to price options on the index, both on the equity index and on the credit default swap index. So that's essentially the flavor of the model we're going to develop. That is going to give us consistent pricing on both sides. So then we will use the model, calibrate it to equity data, to the whole surface of S&P 500 options. And then we will look at the implied credit default swap option surface. And then we'll essentially see whether the two markets have consistent pricing of volatilities. And when, give you a flavor of the main results that we find that actually the model does a really good job. If we were to price separately equity options or credit default swap options, we could do a really good job at pricing the whole surface. But when we calibrate the model to the equity side and we look at the implied, say, credit option surface, we find that it's sort of doing a good job at matching the skew. It does a good job at matching the dynamics. So, for example, a relationship between the spread level and the volatility level. We find, for example, that the model is very good at generating leverage effects. So on the equity side, a negative relationship between the level of the stock market and volatility, and on the credit side, a positive relationship between the level of credit spread and credit volatility. But we find that there is a gap between the two in the sense that the model tends to underpredict the level of the credit volatility. So a model matched to the equity side used to predict what should be the level on the credit side will tend to underpredict the volatilities that we extract from the actual credit default swap options. So it's as if the prices of these options on the credit side were too high relative to the prices that would be implied or replicated using the equity side. And we find also that consistent with that, the empirical, I guess it's the sense in which Dimitri was saying, I'm going to show you how to profit from these two markets, is that if we actually use these different options market to sell volatility, then we find that essentially selling volatility generates higher Sharpe ratio on the credit side than on the S&P side, and a long short strategy generates quite a high Sharpe ratio, and also with very little drawdown risk and better higher order moment in terms of the strategy return. So then we try to discuss why that might be, why we might find such a difference. Why is there this gap? Why is there this apparent quote unquote mispricing of credit volatility? And obviously there's many possible reasons for that, and we have a whole host of discussion in the paper. I'll try to get you through a few of those. First of all, the model could be misspecified, and we discuss a few ways in which our simple model can be extended. It assumes the simplest version assumes homogeneous constituents. It assumes an infinite number of names. So we try to, and we extend the model in many dimensions to test whether these reasons can be an explanation. We don't find that we can explain the gap by relaxing some of these assumptions. It could be that these two options just span different economic states. So typically, we might think that credit options correspond to a strike in terms of the asset value that's much lower than a typical, let's say, 15% out of the money equity option. But we show that actually, when we look at the implied asset value states that are spanned by these two options, they're very similar. And also in terms of maturity, because both of the options we're going to consider have similar maturity. So we don't find this to be a likely explanation for the difference. Now, as I'm going to explain in more detail, there's also differences in the underlying indices. Unfortunately, it would be nice to have an experiment where the credit default swap basket underlying the credit default swap option is the same as the equity index basket, and we have slight difference there in the constituents. So we try to look at the two portfolios, see if their risks are similar or different. We find that they're very similar. And so we find also that this is unlikely to be an explanation for our findings. And lastly, it could be that there is a specific demand for a certain set of options. And so I'll try to argue that this may be partly driving this, although we don't have a smoking gun evidence for that, but we have some anecdotal evidence talking to people active in this markets that the credit default swap options are widely used to hedge CVA, so counterparty risk, and the equity options, though economically they might look that they as if they were redundant, would not be accepted by regulators in the same fashion. And then, of course, there could be some bond-specific factors. So unlike the sort of traditional models I described on the first slide, these structural models, you can develop richer models where there might be some bond market-specific risk factors that needs hedging, and that's distinct from the risks that drive equity factors. So I'll try to say a few more words that towards the end of the paper as well. So this is a very quick summary of our findings and what we do. For those of you that have not much more time, I think you have sort of the gist of the paper. But now let me dig more into the main part of the paper. Obviously, we relate to a very large literature, and in the interest of time, I'm not going to spend much time on all these papers, so I'm not going to do them justice here. The only thing I would like to say is I'd like to point out that our model is very much related to papers by Kelly, Lussigan, Van Neuberg, and Pei, Goldstein, and Yang, who develop, in order to ask a slightly different question, develop a similar model to ours. And I should say, we develop a model similar to theirs. We build on them. What we do differently relative to their framework is, first of all, we have a maturity structure of debt, because in our framework, it's important to have a different maturity for the option from a maturity for the underlying debt issued by the firm. The reason being that our underlying equity options and credit default swap options are very short maturities, 1 to 3 months, whereas the typical credit default swap indices are the liquid ones, 5-year. So it's important that we're able to handle different maturities. In their paper, both bonds and options, everything expires at the same time. And second of all, we're able to derive closed form solutions for all the securities, whereas these guys solve everything via simulation, and that's really useful to be able to calibrate the model throughout the whole sample and do some time series analysis. Okay, so let me jump into the main part of the paper and first give you some overview of some institutional details about the CDX option market and the credit default swap options for those of you that are not familiar. So obviously, this is just a very quick overview, right? We're used to thinking about comparing bond, credit spreads, and equity. This is the whole literature on the credit spread puzzle and its relationship to the equity premium puzzle. Then there's a large literature that looks at equity versus out-of-the-money put. This is the out-of-the-money put premium puzzle literature. And obviously, what we're trying to do here is sort of think about that extra piece here, which is, when we think of the credit spread, is there a similar out-of-the-money credit spread premium puzzle? And is there a link between credit options and equity options? And the way we do this in practice is we need to look at specific instruments. So on the equity side, that's classic. We're going to use the S&P 500 and S&P 500 options. On the credit default swap side, instead of looking at corporate bond indices, we're going to look at credit default swap indices, which are much more liquid, and on which we can get nice data. And sort of the new piece is this CDX option. So let me say at the outset that this puzzle that we're looking at is not perfect, in the sense that what would be great is if the underlying CDX baskets and SPX baskets were exactly the same. They are not the same. So that's something to keep in mind when you think about our results throughout the talk. Right here, the S&P has 500 underlying, and the CDX has 125 underlying. There's some overlap between the two. Obviously, very big overlap between the two, but they're obviously not exactly the same. And so that could be something that drives some of our results, and something we'll try to address later. Would be nice to have the exact same underlying. Obviously, we don't have that. So the credit default swap index we're looking at is the so-called CDX IG. We're going to focus on the investment grade basket. This is a basket that has 125 constituents. When you buy protection via the CDX, you buy insurance on default against 125 investment grade names. 5 years, the most liquid contract. Every 6 months, there is a new on-the-run series that is launched. Most people who trade in this market typically then roll to keep a constant maturity, or roughly constant maturity to their trades. We're going to focus on this on-the-run contracts and options on this underlying on-the-run contract. The cash flows when you buy protection, you typically, if you want to buy protection, you need to pay an upfront, and then you have to pay 100 basis points running on the notional of the portfolio that you're insuring. And in case there is default inside of your basket, then you would simply deliver the notional value of the bond that's in your portfolio and be paid the full principal. In other words, you would receive the loss given default in case of a default in the underlying portfolio. The price of the upfront reflects obviously the price or the present value of the protection payments you might receive minus the present value of the running coupons you have to pay. So the quoted price in the market for the insurance is this price of the upfront. However, you can immediately see that the price of the upfront is not directly economic meaningful, in the sense that, for example, the price of the upfront could be negative if the present value of the coupon was higher than the present value of the protection payments. But of course, a negative upfront payment, meaning that if you were to buy protection, you would receive an upfront to start out with, does not mean obviously that there is no risk out there. It just means that the running payments are already large enough to compensate the setup protection for the default risk. Therefore, in order to get something more meaningful, it's sort of standard in the market to transform these upfront prices that are quoted into a so-called par spread. And the par spread essentially is an implied full running coupon payment. So the par spread, if you want, is a transformation of the upfront using a standard model, which essentially allows us to quote the credit default protection in terms of a annual insurance premium, an implied annual insurance premium that one has to pay to insure against 125 names defaults. So For much of my talk, when I talk about an option on our credit default swap spread, I'm going to think about the par spread, so the economically meaningful quantity, which is the essentially annual insurance, annual cost of the insurance of insuring the basket. Okay, and so then if we think about options on these credit default swap indices, we have payer swaptions and receiver swaption, and just like with equity options, we can of course buy a pair swaptions or sell a pair swaptions, or we can buy a receiver swaption, or we can buy or sell a receiver swaption. These options are essentially rights to buy protection at some future date at some pre-specified upfront. Alternatively, we can think of these options as the right, if we think of a payer swaption, as the right to buy protection at some annual par spread, right? So the strike would be the annual insurance payment that would be fixed, and then at some future date, say in 1 month, we would have the right to buy protection on the 125 names at this pre-specified spread. So we can think of the payer swaption as a call option on the spread. And so for the rest of my talk, so I don't want to confuse you or myself by thinking of all the various options, I'm going to focus mostly on these call options on spreads, so these payer swaptions. The reason I'm going to focus on these is these are the natural one to think about when we want to compare them to the classic out-of-the-money put on the equity side, right? So if we think about it, when we buy an out-of-the-money put on the equity, we're essentially buying crash protection. This is the out-of-the-money put will pay off on the equity side when the equity market tanks. The equivalent contract on the credit side is the call on the out-of-the-money call on the spread, right? Obviously, when the market tanks, we think that the credit spreads will widen tremendously. And so if we had bought a call on the spread at a fairly high strike, then this will provide out-of-the-money protection against crash risk or large amount of credit risk. And so the things we want to compare is what are the implied vols on these out-of-the-money call on credit spreads versus the implied vols on the out-of-the-money put on the equity indices. And we can see from the structural model intuition that, of course, there should be a tight link between the prices of these two contracts. And that's exactly what we're pursuing in our paper. I'm going to focus on that, right? Out-of-the-money call on credit index spreads versus out-of-the-money puts on equity baskets. To give you some sense, we have data on, so the nice thing is that we can access now, after Dodd-Frank, we have access to data from these data repositories, and we can see get a lot of information on transactions in these markets. And so I'm going to show you some data on trading in these markets. So you can see here, for example, on the first column, you have the trading in the underlying CDX, and here you have trading in the underlying credit default swap options. You can see that credit default swap options are quite liquid in a sense, and you see pictures on the next slide that shows you that also this has been improving over time. But you can see that there's on average in our data sample, which goes from 2012 to 2020, you can see there's about 18 trades per day, a lot more towards the end of the sample, with a median trade size that looks like 100, but actually that's a misleading number because 100 is the reporting to the trade repositories is capped at 100 million, but we can actually estimate using some data from specific platforms where we have more information. We can estimate that the conditional on a trade being capped, the average trade size is around 350 million. So it gives you a sense of the volume and the size of the trades, which are fairly large in this market. The average daily volume that we therefore estimate is around 1.4 billion per day. You can see that almost all the trading happens in the 5-year, so the most liquid underlying, and for the underrun series. And you can see that a lot of the trading happens in those contracts that I'm going to focus on, namely those payer swaptions, and especially the out-of-the-money ones. Here is data on time series evolution of the volume in these markets. Left-hand side is the underlying, so the credit default swap insurance or standard protection on the basket. Right-hand side is the trading in the options markets. You can see the upper panel is in dollar volume. The lower panel is number of contracts. So both of these give you the same picture, which is a big increase in both the volume of trading and number of contracts, which you can see a huge spike during the recent crisis that we went through during the COVID-19 crisis, right? And I'll give you some more information on that later. Here you can see the trading across the surface. You have the maturity of the contracts on the x-axis. You have the moneyness of the contract on the y-axis. Moneyness we express in terms of number of implied standard deviations that the strike is away from the current forward. And so you can see that if you sort of glance at this table, you can see that most of the action, most of the trading happens around here, which is essentially, as you can see, out of the money pair calls, like I was saying, right? So calls on the spread and fairly short maturities. So in the first sort of 3 maturities that we have, and out of the money option, that's where most of the activity in this market is. This is from some marketing material from JP Morgan. I'm not sure how scientific the underlying data is to that. We don't know, but it sort of gives you a sense of what the market participants think where the action is happening. You see it's roughly 50-50 buy side and sell side. So you have these two guys here are asset managers, hedge funds, and then here you have broker dealers and banks. So it sort of gives you a sense that it's 50-50 activity of sell side and buy side according to this one piece of data we have. Now we are going to use quote data to calibrate our model. We're not going to rely on intraday transactions data that we have, simply because we want to get consistent pricing across the surface. So we want to have roughly the same timestamp, and we wouldn't be able with the intraday actual transaction data to populate a full surface at the same time. So that's why we rely on end of day dealer runs from market. And this picture just is a sort of graphical way of showing you that most of the quoting activity happens in the first 3 maturities. So every color coding here corresponds to maturity, from the shortest maturity to the longest maturity we have available. You can see that in longer maturities, the data is still sparse, at least at the beginning of our sample. So we're going to essentially use only the first 3 shortest maturity we have to do our exercise. So that means we're focusing on first 3 maturities, 1, 2 to 3 months options, and we have about 13 moneyness intervals. So 13 times 3 is the underlying number is the surface of options that we're going to calibrate our model to. To show you some evidence on the volatilities from this market, I'm going to essentially we're going to run regressions of the quoted implied volatilities on the moneyness, and I'm going to report the intercept as our estimate of the at the money vol, and the slope as our estimate of the skew. And that's the 2 numbers I'm going to focus on. And so this first picture gives you some sense of the at the money level of implied volatilities and the skewness on the credit side. So left-hand side is credit data, right-hand side is equity data. The first panel up here shows you what you would have expected, which is on the right-hand side, you can see the S&P 500 level. So you can see the large drop that we experienced during the COVID-19 crisis. And this is just an extract to show you what the action during the COVID-19 crisis. And you can see the corresponding action on the credit side. So this would be the cost of insuring. Again, this is the par spread. So you can think of this as the price of the annual price you'd have to pay to insure the 125 names. Red is for 1 year. That's the 1-year insurance contract. And then blue is the 5-year insurance contract. So you can see that typically the slope is positive. So it costs you more to insure at 5 years than at 1 year, quite intuitively. But sometimes that switches. You can see around here, you may have much flatter or sometimes even inversed credit spread curves when you're in bad states of the world. You can see that as the S&P tanked, credit spread widened tremendously, not surprising. Now, this is the commensurate picture on the volatility side. So this is the at the money implied volatilities from the credit market and from the equity market. And so you can see the picture that you're all familiar with, which is that the would have paid a lot to sell volatility at the height of the COVID crisis. We attained some unbelievable levels of 70% implied equity option volatilities. Well, consistently, we had very high implied credit spread volatilities. Now, again, one of the issues is we can't look at this number and compare it to that one, because this is the implied credit spread volatility using a reduced form model, whereas this is the implied equity option volatility using a Black-Scholes type model. So these two numbers are not readily comparable, but at least the dynamics seem consistent, right? Both on both sides, implied vols, so risk premia or actual risk increased tremendously. Things start to be more interesting when we look at the skew, the implied skews from these two markets, because there we start to see that based on these two numbers, you might have thought, well, they're very similar. Why do we need these two contracts? Here you can start to see differences when you look at the skew. So obviously we think of the skew as a measure of the crash risk premium. You can see that skew became much more negative, right? Implying that the price of the out of the money puts became much more expensive as we went through the crisis. And then we recovered somewhat after the first measures were taken. Now, what would we expect on the credit side, right? So the fact that the skew becomes more negative on the equity side means that out of the money puts become relatively more expensive. The corresponding thing we would expect on the credit side is that the skew becomes more positive. Remember, we're looking at credit spread implied volatilities. Right, so we're worried about a widening of the credit spread, and so if we think that crash risk becomes more important on the credit side, and we think this should become more positive, right, as the price of the out of the money credit spread calls becomes more expensive relative to the at the money ones, and so that's what we see initially, which is a widening of the skew, which becomes much more positive. But notice that it reverts much earlier than on the equity side. And so those bars corresponds to various events, right? Like the Wuhan lockdown here, and the bars where you start to see an early reversal in the implied credit skew correspond to when the Federal Reserve made announcement that they would support essentially bond prices by essentially buying bond ETFs. So this is, of course, just anecdotal, but it may give us some insight that there are some factors that maybe affect here implied credit crash probabilities that are not directly having the same impact on the equity side, and maybe that's one of the explanation for some of our next findings. At least it's an interesting sort of anecdotal type of evidence to look at to see the market. This is more looking at correlations. I'm not going to take you through every one of these pictures. I don't want to to lose you, but the essentially what you can see here, for example, on this left-hand side panel, is that there's of course a strong relationship between the level of the S&P and the level of the credit default swap index. Here you get the classic leverage story, right? And the equities on the equity side. So when the S&P drops, then the implied S&P volatility increases. Well, we have a commensurate leverage effect on the credit side. When the credit default swap index widen, the cost of insurance increases, then the volatility increases. And so we can look at various of these features, relationships, and start to see that whether they're consistent, thinking about it through the lens of our structural model. And the last piece of evidence, stylized facts that I want to show you to make you more familiar with these credit default swap index options is the right-hand side is the classic picture of the skews that you're familiar with, the S&P 500 skews. And as market volatility increases, we go up and we get a steeper skew and a steeper level of the at the money vol. This is the corresponding picture on the credit side. You can see that we see a positive skew here. Again, that's first maybe puzzling, but when you think about it, it's natural. It's what you would expect, right? That as the conditions worsen, the credit spreads widen, and the value, the implied vols, correspondingly increase. Okay, so now again.
So let me jump in and ask a question before you go to the theory. So from Ken Dutch, it's could the divergence in the two markets in late March be due to government policy to protect firms from bankruptcy, but not guarantee their profitability?
Yes, I think that's a really good point. I think that's that's exactly what I was trying to make you think about here. And yeah, it could very well be right that the market was expecting, for example, fire sales, the necessity to sell some of these corporate bond indices, and that this would have tremendous action on prices, and obviously, that might have some impact on your on the default probability, certainly on implied credit spreads, and to the extent that there's obviously a link between the bond prices and the credit default swaps and the credit default swap pricing, this may be a factor that was of tremendous worry to the bond market participants, and that was to a large extent alleviated when the Fed stepped in, and it didn't have quite the same impact, like you say, on the for firms where maybe they project further in the future, like you mentioned in your comment. So I think that's definitely one of the potential explanations for why we might price in different risk factors on the bond and on the credit side, on the equity side.
Okay, now that I've interrupted you, there's one other outstanding question. So it's a multi-part question from Gustavo Schwenkler, and you already answered some parts, but the remaining part is, I'll edit the question a little bit. What makes you think the large homogeneous pool approximation will work well for the CDX index that has 125 names?
I mean, I of course I don't know, right? Are we closer to infinity when we're at 125 than when we're at 500? It's a great question, right? So initially we're just gonna assume it is, and then what we have done in the appendix to the paper is we have actually run some simulations. So we actually simulated. The nice thing about the large homogeneous pool formula is that we have closed form solutions, so we can calibrate it and run through the sample. But then what we've done is we've run some simulations where we can, of course, compute the solution with 125 names, the solution with 500. And we do find that the error we make due to this large homogeneous pool approximation, it does go in the right direction, in the sense that having more names, right, makes you less risky. And I was going to say that towards the end of my talk, but I may never get there. So I'll just say it right away. So it does, the error we're making by making the homogeneous pool approximation does go in the right direction of essentially explaining our findings. However, the magnitude of the explanation we get is very small. It's very, very small. So we have pictures in the appendix to the paper where you can see that the error we do, while it goes in the right direction, in the sense that we underestimate more the value of the credit option, and we underestimate the value of the equity option, because 500 is closer to infinity than 125. But this error is not the explanation for the size of the gap that we find.
All right, I should let you move on. You have 21 minutes left, so I think I'm going to defer any other questions to the.
Okay, I'll run. Okay, thanks a lot. Thanks a lot, Neil. So here's the model we're using to essentially try to compare these two implied volatilities from these two markets. We're going to have an underlying asset value for every name in our basket. The underlying asset value will have some common factor that has both common Brownian shocks and common jumps. And then each name has also idiosyncratic Brownian shocks and idiosyncratic jumps. There is every firm in the basket will be issuing short-term debt and long-term debt, and default will occur optimally at each date, meaning at the last period, of course, the firm will default if the underlying asset value is lower than the promised debt outstanding, and at the initial period, the firm will default if the continuation value is lower than the current payment it has to make. We have this defines over endogenous thresholds, and then we will assume that in case of bankruptcy, a fraction of the asset value is lost, and that both debt holders receive the remaining fraction of the asset value in proportion to the outstanding notional outstanding. So pricing, when we look at pricing individual securities, is really very standard financial engineering. So I'll just take you through one of these equations, and all the other ones are similar, right? The price of the short-term bond essentially is the discounted value of the promised payment at time one if there is no default. Default will not occur if the asset value is greater than the default threshold. If the asset value is lower than default threshold, then we'll get a recovery, which is some fraction of the outstanding asset value at that time. And so this is classic option pricing. We have explicit solution for all of these that look very much like Black-Scholes type formulas, and we can do the same for the long-term bond. And we can, and then of course we can use either Modigliani-Miller, or we can use a similar equation to price the equity. So when we think of individual debt and equity, that's very classic. And then of course we can price credit protection. Credit protection will be, essentially paying a continuous coupon and an upfront. So that the present value of the continuous coupon and the upfront balances the present value of the protection payments. Protection payments will be received in case there is default at time 1, or if there hasn't been default at time 1, but there's default at time 2, and the loss given default is then recovered in each case. So it's classic. At the individual firm level, we can price all the contracts in closed form. Things become more interesting when we start to look at the indices. When we think of, for example, when we think of the credit default swap index, the credit default swap index is essentially a sum of the underlying credit default swap, individual credit default swaps. So that would be the formula for finite n. In practice, we should use n equals 125. So that's what we do when we do simulations. But to get closed form, we push n to infinity, and then we use the trick of Vasicek, which is that essentially if you condition on the common factor, then we can use essentially the law of large number, and we can essentially rewrite this this average here as just an expectation. And because of the underlying dynamics we've assumed, all these conditional expectations can be performed in closed form. So we get an explicit solution for the index. Similarly, for the equity index, it's also a sum of all the underlying constituent equity values, and we can use the same trick to get the distribution for the index explicitly. And then using the distribution that we know explicitly, we can calculate the value of an option on the credit default swap index, where essentially we know the distribution now of the index, and we can again perform all these expectations in closed form. So we have explicit solutions for all the products. Similarly, on the equity option side, we have the distribution of the equity index, we have the max operator, and we just do some algebra and do some calculate some conditional expectations, and so we have closed form solutions for every one of these contracts. So now we can try to do some focus on the relative pricing calibration, and so we're going to calibrate the data to the equity side, and then look at the implied values on the credit side. We have a procedure when we calibrate this model. The one thing I would like to focus on is that we make sure that every time we calibrate the model, we always match perfectly the 1-year and the 5-year credit default swap index level. So we have the same amount of risk neutral expected loss that we calibrate across all models, and we make sure we hit the level of the S&P perfectly, and we calibrate to the S&P dividend yield, and we calibrate to the average and short and long-term leverage of the underlying constituents of the CDX and the SPX basket. We got that data from Compustat. So we make sure we match always these data perfectly, which means then that we are left with only 4 parameters that are essentially 4 degrees of freedom, which we then fit to minimize the sum of squared errors on the 39 option prices across the surface on the equity side. And then with those parameters calibrated to match as well as we can the S&P 500 option surface, we look at the implied credit default swap option prices. So in the paper, we have when we do this, we recalibrate every week, and so we can look at the time series of the calibrated parameters. And you can look. I will, in the interest of time, I'll just move on. So let me just give you some of the main features. So first, what happens on the equity side? On the equity side, we get that the model is really is able to do a fairly good job. This is using one particular day to just give you a sense of how well the model does when you calibrate it. The model does a really good job, and that's sort of well known from the literature, at matching the surface of S&P 500 options. Now, on the left-hand side, this is just the sanity check, is saying, could the model also fit the credit options if we made sure to in-sample, try to minimize the sum of squared errors on the credit side? So that's what we would get. And here, this is not consistent pricing. This is just, let's just price one market in sample or let's try to price the other market in sample. And so what we can see is that at least in principle, the model can do a really good job at fitting the term structure of equity or credit separately. Now that's not obvious, by the way, because the blue line here is the best the model can do if we turn off the jump components to the model. So you can see here that on the equity side, if we try to match to price the model perfectly on the equity side, we do a terrible job if we don't have jumps. What's interesting to me, my co-authors don't think it's as interesting as I do, but I like this result, is that actually not only can't we do a good job at matching the data without jumps, but actually on the credit side, we even get the wrong sign. And that's something we can prove analytically, which is that the standard Merton model with no jumps will actually generate the wrong sign of the skew. It'll generate a negative skew instead of a positive skew on the credit side. So to me, the reason I like this finding, which kind of surprised me at first, is that it sort of shows us that if you might have thought that the leverage effect we see implied from equity options could be explained by financial leverage effect, clearly this doesn't seem to be the economic explanation for the leverage effect, because on the credit side, the financial leverage effect predicts the wrong sign of the option skew. Okay, now what happens if we now do the calibration on the equity side? So this is the implied model and data based on the model, and we look at keeping the parameters fixed and looking what the model predicts on the credit side. This is for one typical day. You can see that the model versus data, there seems to be a sort of downward shift. So the model does a pretty good job at getting the shape of the smile across maturities, but it seems to be shifted down by some constant amount. And so this is one day. This is the time series effect. So the first 4 panels is data that the first 2 panels is data we calibrate perfectly. This is the at the money implied equity option volatilities that we calibrate perfectly, and this is the out of sample at the money levels that are implied on the credit side by the model calibrated to the equity side. So you can see that essentially the data blue line is higher than the model implied by essentially some fairly significant amount. On the other hand, for the skew, the model does a good job at predicting both the time series and the level. So you can see that really the issue here is in terms of the level of the at the money vol, there seems to be some gap, and that's sort of our main finding, that it seems that the level of the credit implied volatility is higher than what a model calibrated to the equity side would, a structural model calibrated to the equity side would predict we should see. Now, is this constant? It's actually not constant, so it seems to be coming down. So I don't know how much you want to read into this, but one might, by fitting a straight line through this, see that the quote-unquote mispricing is starting to go away. But I mean, that's just, in the eye of the beholder. But it seems to be that it's coming down both in absolute and in relative terms, but it's going down slowly. Okay, the time series, the model is very consistent with the data. So our main finding seems to be that, again, the level of credit implied, the model calibrated to the equity side predicts a level for the credit implied volatility that's a lot lower than what we see is priced in the market. So what could be explanations for this mispricing? How much more time do I have, Neil? I have
you have a hard stop in 9 minutes.
9 minutes. Okay, so there could be many explanations, right? So first, our model, is quite, even though it's rich, it has lots of simplifications, right? So Gustavo pointed out that we assume an infinite number of firms. So it could be that we have a finite number of constituents. Again, we do simulation analysis. We find it can't, while it does go in the right direction, it doesn't seem to be able to explain the magnitude of the difference we find. We have assumed in a simple model that all the firms are homogeneous. They have the same leverage. We have a cross-section. We have evidence, obviously, that there's cross-sectional heterogeneity in leverage. So we generalize the model, which is not too hard to do, to allow for different groups of leverage, and then we fit the number of groups. So we match the mean, the median, and the cross-sectional standard deviation in leverage that we observe in those 2 baskets, in the CDX and in the SPX, and we find that heterogeneity actually goes in the wrong direction. So adding heterogeneity actually increases the puzzle because essentially there's more dispersion on the SPX side than there is on the CDX side. Then, we don't actually have stochastic volatility in the model, and so we haven't actually done a robustness check on that, because first of all, the model is recalibrated weekly, and second of all, our intuition is that adding stochastic underlying asset value volatility will actually increase the value of both the equity and the put option, essentially in a similar way. So what we need essentially to generate a gap between in the structural model between the credit option and the equity option is something that essentially adds risk to the put, if you want, without adding risk to the call. And so we need something very specific. So inside the model, for example, the thing that would do the trick is to add stochastic bankruptcy costs. Bankruptcy costs only affect the payoff to the bond in a simplest structural model, and they have no impact on the payoff to the equity. So if you make bankruptcy costs stochastic, then actually you have a factor that's bond specific within the structural model, and that can increase the value of credit options without increasing the value of equity options. So we have an extension in the paper of that model, and we do indeed find that such a model can reconcile both sides. But of course, now we have to justify why we need such a high level of the volatility of bankruptcy costs. So and from our perspective, it's a way to restate the puzzle. The model, the prices are consistent with a very high implied volatility of bankruptcy costs, if you want. Then we have a host of other potential explanations we go through the paper, which is more related to in a more, why might these two products not be redundant actually from the point of view of market participants? The first thing is they might span different economic states. Again, typically we think of bankruptcy as some very far out of the money strike, perhaps much further out than the strikes that are implied by the equity puts. And if that was the case, then maybe we're making essentially a mistake because we're calibrating to the equity side and then effectively extrapolating to get the values of the credit puts, and maybe the extrapolation is a mistake. But actually, one thing we do is, given the model, we can transform the strikes that are quoted in terms of credit spreads and the strikes that are quoted in terms of the S&P into underlying asset value levels that will be hit for the options to be in the money. And we can compute, therefore, the asset value range that these option prices are consistent with each other. And what we find is they're very similar. So both in terms of the maturity of the underlying option, 1 to 3 months, they're the same on the credit and the equity side. And in terms of the span of asset values that are implied by these option prices, by the strikes on these option prices, these two contracts seem very similar. So they don't seem to span different economic states in that sense. So they seem to be very much redundant. So then it could be that the underlying indices are very different in terms of their risk characteristics. Again, we have 125 underlying for the CDX. All of those firms obviously have outstanding debt. On the SPX side, we have 500 underlying firms, some of which, for example, have no debt, right? Obviously, they couldn't be in the CDX index. So do we have very big differences in the index characteristics? So there, what we do is we collect data on from Compustat on leverage and ratings, and we also compute underlying asset value volatilities. And we look at the distribution. And so here, for example, you have the distribution of leverage for CDX, leverage for SPX, the ratings for CDX, ratings for SPX. And if we look at the distribution, both the mean and the median are very similar, both on average and in time series. This is the average leverage, for example, for CDX and SPX. And if anything, the dispersion is always higher on the SPX side, which would suggest more risk on that side. This is if we compare the distribution of underlying asset value volatilities, right? In the structural model, what's really important is both the leverage, essentially the distance to default, and of course the underlying asset values, and specifically, of course, the amount of systematic asset value volatility. And so what we do is we collect as much data as we can on the underlying returns of the firms and their debts, and then we compute unlevered asset values for these firms, and we calculate their asset value total volatility, and we calculate their asset value systematic volatility using a one-factor model, and we look at the distribution. And what you can see is that both in terms of mean and median, these are very similar, in fact, indistinguishable. The means and the medians are not distinguishable statistically. However, the dispersion is slightly higher on the SPX side. So we think of this as sort of supportive evidence. At least it doesn't feel like this is striking evidence that there's a lot more risk, at least in terms of the risk that would be important from the point of view of the structural model. Doesn't seem to be a lot more risk on the credit default swap side than on the SPX side, neither by looking at the distribution of asset volatilities, systematic asset volatilities, leverage or ratings. So then lastly, if you buy that, maybe we're missing some dimension of risk, but at least the dimensions of risk that seem to be crucial from the point of view of the structural model, in these dimensions, we don't seem to find that these two indices are very different in terms of the risks that they carry. So the last two pieces could be that actually these products cater different investor demands. So there might be very specific demand for one product versus the other, and then if the supply of insurance is not perfectly competitive, then maybe we could generate some pricing. So we don't have, of course, the smoking gun evidence that this is what's driving it, but we have a lot of anecdotal evidence that there's a lot of demand for these CDX swaptions to hedge CVA risk, and that regulators would not accept an SPX options to hedge a bond portfolio or to hedge counterparty risk, but they're willing to use CDX swaptions as risk mitigating trades. So that might be one reason that that generates the difference in demand for these CDX swaptions. Now, we don't have smoking gun of course, on the demand side, but one thing we can do is sort of see whether, from a point of view of a trading strategy, these two markets reflect similar risk premia. And so what we do is in the paper, we do several here. I'm just showing you one experiment, which is we look at different ways of selling volatility via those two markets. And so if we look at selling closest to at-the-money straddles on the CDX side, you can see that the Sharpe ratio in full sample that you obtain is around 1.7, whereas if you look at SPX options, you get a Sharpe ratio full sample around 0.65 for the same period. If you exclude the COVID-19 period, then you get even higher Sharpe ratio. There was much more volatility during that COVID-19 period. So you get a Sharpe of 2.2 on the CDX side and 1.1 on the SPX side. And if you look at a long-short strategy where you sell volatility via CDX and buy volatility via SPX, you get a very high Sharpe ratio of 0.9, which is higher than SPX, lower than CDX, and roughly consistent across both periods. And this strategy is also much better from a point of view of higher order moments or drawdowns. So you can see sort of a picture. This is the returns to selling volatility outright via credit. This is the returns for selling volatility outright via the equity market. You can see these gigantic, or maybe not gigantic, but very big drawdowns, which if you look at the long-short strategy, you don't see anymore. So you get a slightly higher Sharpe ratio than for selling CDX outright, but you gain a lot when you look at skewness, kurtosis, and drawdown. So these results on the strategy seem to suggest that they're not really, they might be suggestive that the volatility implied in credit is priced at a higher implied risk premium than the volatility priced in SPX. All right, so I'm way over time. So let me conclude. I've tried to give you some picture of this new CDX options market. It's interesting, this market, because it gives us some view into the pricing of credit implied volatility by market participants. At least in a structural model, if the underlying baskets were the same, we would expect very tight link between the implied equity volatilities and the implied credit volatilities. There are tight links, at least empirically, in the sense that they're highly correlated positively. The volatilities, the skews seem to be related, and many of the dynamics of these markets seem to be consistent with what would predict with a structural model that's calibrated to one side and looking at the other. However, there does seem to be a higher implied credit risk premium, credit volatility risk premium priced in than an implied equity volatility risk premium. And so the jury's still out there why that's the case. And so we've discussed a bunch of these possibilities. And with that, I think I'll conclude.
All right, Pierre, thank you very much. At this point, anyone who wants is welcome to unmute him or herself and ask your question with the microphone. While I'm waiting for you to do that or to think of your questions, I'll ask a couple of the questions from the chat. From Tobias Sichert. The data period you are using is by large a period of very low volatility. If you have not done it already, it might be worthwhile to look at the time series of your results and check if they change with the level of volatilities. I guess that's really a comment and not a question, but you're welcome to respond to it.
I mean, I would argue that the period of the COVID-19 period, I would not argue was a period of low volatility. I mean, I think, I don't know, you know, we had quite high volatility, 70% for the S&P. So I'm not exactly sure what you have in mind. I mean, certainly we got an episode with very high volatility in the data sample, right? So it is true that the I think maybe that's what you. It's true that the dynamics change a lot, right? So if you look at this table here, for example, the implied profitability of the strategies are very different whether or not we include this period of very high vol. So maybe that's something you have in mind. But so we have looked at how these the strategy look in lower vol period and then including the higher vol period.
From Steve Figluski, could you tell us more about delta hedging or other risk management for the two options markets? They seem quite different.
It's an open-ended question. I'm having a hard time answering that, but I agree with you that so you know, at least in principle, right? The via our structural model, if you buy that structural model feature, they should be very similar, right? So if there is no such thing as like stochastic bankruptcy cost or some reason why there's a wedge between the two, then there's no reason that you shouldn't be able to do the exact same hedging strategy on both sides, right? The one is an option on a corporate bond, so that's, you know, that's essentially a put on the underlying asset value. The other one is a call option on the underlying asset value, the stock, and so hedging one and the other should be very similar. But I agree with you that the market approaches them very differently, and in fact, right, quotes them using very different models. So the assumption on the credit side is that there's an underlying, right? There's a jump to default, and then we think that it's the intensity that's the process that's varying, and then we use some delta hedging of that variation in the intensity. And
well,
actually,
Pierre, what I was really trying to get at, I think, was not so much the mechanics of doing a hedging transaction, but actually who's doing it. It seemed to me that the CDS options market you're talking about, with 18 transactions a day of averaging $300 million each, you have a small number of people who are going to end up bearing that unhedgeable delta risk, the gamma risk, and all the other risks that are involved in trying to run a risk management system for options. That's a lot different for the people who are making markets in the SPX market. And it just seems to me that a big jump could really just kill one of the market makers who are making markets in huge size in this very narrow market.
I think it's a great point. I mean, I think it's a great point. So I think you just I like your comment a lot, and I couldn't do a better job at saying it myself. I think it might be one of the partially an explanation for why you see a gap. Maybe it's sort of so. I think it's a very good point. The structure of the market is very different. Similarly on the underlyings, of course, right? If you look at CDX, right, the trading in the underlying CDX is very different in terms of size and number of trades, even though it's very liquid, quote unquote, by bond standards, by the standards of the SPY. It's SPY mini. It's not at all the same style of trading. So that's also related to the question whether market structure. So the fact that a lot of these the quoting is very different, right? We're talking about OTC markets on one side and versus organized exchange on the other, whether this has an impact on the pricing. It's just that in general, I would think the OTC structure has certainly an impact on bid-ask spreads, etc. Sort of more measures of market liquidity, but would they have such a big impact on the level of prices is always a different question. And here we find that really the level of the implied volatilities, so the mids, are quite different. And so then you have to argue something like along the line of what you're saying, which is that maybe right, it's demand-based option pricing, and there's not sufficient entry in this dealer market, so that somehow they're able to price in a lot higher risks. Mm-hmm. Of course, then also on the demand side, if you buy the structural picture, why, if I'm only interested in the payoff, why would I pay so much more for buying insurance via the credit side when I can get really the same type of insurance by buying the out-of-the-money put at a cheaper price? So if I'm just purely interested in financial risk management, right, economically I'm hedging the same states. So why wouldn't the demand move to the equity side? So then we need some other feature, maybe something like, well, regulators will not allow you to hedge a bond portfolio with an equity option because they just view this as not covering the same risks. Right? Or the next step is actually there are different sources of underlying risks driving these two baskets, and that's why we need a different product.
So let me ask a follow-up question here. So you talked about, the possibility that the, large, whatever, derivatives dealers are using these for CVA hedging. Do you know, is that a large fraction of the trade in these markets, or is that just one possibility that might be a small fraction of trade? Do you have any sense?
Yeah, so we tried. So Anders he wanted to answer the exact same question. So he went out and he figured out. He looked at the accounts of the main broker dealers, and he extracted from their accounts. There's some mention of the amount of CVA risk hedging that they do, and so he constructed really cool. If you go to I don't have it in the slides, but if you go to the appendix of our paper, he constructed some measure of the amount of hedging due to CVA by the I think 8 or 10, I forget the exact number of biggest dealers from who we get data from. And it's a sizable number, but of course we don't really know, right, how much of that is done using these products. We don't really have the exact specific, right? So we could make some back of the envelope calculation by saying if all the hedging was using CDX options, that would be the amount of delta that would be due to that CVA hedging. But it's a very sizable number. If you look at, I mean, I don't have it off the top of my head, but if you look in our paper in the appendix, we have some time series estimate of the amount of CVA hedging done by the largest broker dealers.
If I can step into this with some market perspective, even if it's not all being done for CVA hedging, which then would be dictated by hedge accounting rules, the flows in this market are almost all one way. You said it was a 50-50 market. You have the makers and the takers. The investment banks are the ones that are generating these products as a purchased protection for all the other users. And so you don't have a liquid two-way market like you do in equity options. I mean, people use options for all sorts of strategies. People are using this because they must. And I think that diminishing return that you're seeing, the mispricing, is as this becomes a more regular product and more participants come in on the design side, the price will become, it'll narrow down. It's basically, when you have a few sharks in the water, they can take whatever they want. And as more houses are competing, then the spreads have to narrow.
Interesting.
All right. Again, I encourage anyone who wants to jump in to use their microphone. There's a comment from Dima that it's a comment, so I'll let you read it in the chat. So then there's only, when eventually Dima will send it to you, but there's only one outstanding question. The question is, You have calibrated the model on one market and checked the fit on the other. Out of curiosity, have you tried to keep an out of sample period to see A, if your model isn't overfitting the equity market volatility surface, and B, if the problems when you try fitting both markets at once are similar when you try the model with data that the model has not yet seen?
Okay, so I mean, it's good, and we haven't done what you're asking us whether we've done it. The only thing about overfitting, I think, our model is fairly parsimonious. So in the end, we have 4 free parameters to fit 30. What was it? 39, I think. 39 options. So it's the model itself is fairly parsimonious. We do not see, for example, that we recalibrate the model weekly. We do not see that the parameters are varying all over the place. They seem to be fairly stable over time, which sort of makes us think that the model is not too crazily overfitting. But it's a good point. We could try to. I'm not exactly sure. I mean, I guess the natural next step, if you didn't want to have to recalibrate the parameters, would be to actually specify a model with stochastic volatility, for example, and then estimate it with constant parameters for the whole period. That would be the natural thing to do. And we thought about how to do that, but turns out it's very hard for us to get an explicit solution when you have actually stochastic volatility. And so then we don't have a closed form solution. And if we have to estimate this thing via simulation and then try to do some maximum likelihood or something like that, we don't have a good way of doing that. But it's something we could try to do. Fitting both markets at once, we've tried that. So we've done that, and you get what you would expect, right? Which is that you're somewhere in the middle, right? So so for example, if you will do a better job if you assume 100% bankruptcy cost, for example, right? So there are some ways in which you can generate, you can get the model to fit better the two markets. You need to play with the parameters that essentially create a wedge between the equity side and the bond side, and so something like bankruptcy costs is the only parameter actually we have in this model that generate a natural wedge between equity and bond sides. I'm sure that answers your question.
Okay.
Can I jump in? I think this high frequency data on CDX options can be quite useful. You can see whether those trades are actually one-sided, and it also helps you estimate the limits of arbitrage in that market, which is related to your story. That's one comment. And a second comment, could you try to estimate this on VIX options? Is it helpful? Because VIX options will be more this tail of the tail of S&P 500, which could be like conceptually maybe closer to CDX options. Just an idea.
Yeah, so it's interesting what you're saying, because many practitioners they are, I think what you're saying is you think of VIX as closer to credit spreads, and so you'd like to have VIX options, and that we get this comment from many practitioners who sort of typically there's a lot of people that have empirical models. A lot of credit houses that trade credit, they have empirical models where they fit credit to VIX. And so they sort of think of trading VIX versus credit, or view the changes in the difference between the two as trading signals for one market or the other, which then of course makes you think of the credit option as closer related to an option on the VIX. But from a point of view of the structural model, I think it's not what you want to do. And from the point of view of the structural model, really the linkage is there's the underlying asset value, then there's debt and equity, and then then there is the option on the equity and the option on credit, and they're really tightly related. And so in fact, that's what the model says. And then if you look empirically, actually the empirical just regression analysis shows also that there's a tighter link, for example, between S&P and CDX than there is between and then between the implied vols than there would be between CDX and VIX, for example. So the just linear regression also seemed to be consistent with the structural model in that sense. But I think it would be interesting to also bring in an option on the VIX, but right? It's an additional layer. But one thing that we could do actually, and we've been a bit lazy, but we already have very large appendix. It would be to bring in S&P 100 options, because right, you have, that would be interesting, I think, because you have a 500 S&P 500 in options. Like Gustavo sort of said, well, 500 is much larger than 125, so we could also try to bring in an equity option on 100 names. Maybe would be another thing to look at, which might be interesting to see whether we find the same problem there. Then at least we can say it's not driven by the different sizes of the underlying baskets. That might be an interesting thing to do, which we haven't yet done.
All right, thanks. So last chance to ask Pierre a question. Last chance to tell Pierre he's completely wrong. I'm sure no one would do that.
Well, they might all think it, but they're too polite to say it.
I would have another question.
Can we tell Pierre he wrote a nice paper?
Go, Tobias, go ahead, please.
Sorry, sometimes I have issues with my microphone. Hi. So if I understood correctly, you're only estimating your model on the prices, right? Not not on the P dynamics, right?
Yes. We're just doing Q dynamics. We're not looking at P measure stuff, which would be also a nice thing to do. I mean, the only thing we do that's P related is this. It's not model based. This last experiment when we look at trading strategies, where there we look at implied Sharpe ratios or risk premia. So that's, but it's not model related. So in the model we don't have any, any counterpart to that experiment. Yeah.
Yeah, exactly. I was going in that direction. So there's a nice recent paper by David Schreindorfer and a co-author. And what they show essentially is that models that match the skewness in options do this usually when they have jumps by pushing a lot of P density into the tails, but actually it doesn't match the data. And what they then do not match is the wedge, so the pricing kernel in that area. It's just not high enough. I'm not sure about how this would extrapolate to the CDS options, but that might be what's going on. And I'm assuming if you would look at the model counterpart, the model implied option returns, that they are not as low as the empirical ones.
Okay, I mean, that's a good point. I don't know this paper, so it's something I'll definitely look at. Yeah. So it sounds like a good comment, something I need to look into. So thanks a lot for that.
My pleasure.
All right, anything else?
All right, if there are no further comments, let me conclude. So thank you, everyone. Hope you enjoyed the seminar. We will be back in 2 weeks with another paper on derivatives. So thanks again for coming in.
Thanks a lot for having us. It was great. Thanks for the comments.
Pierre,
bye, guys.
One extra comment is for this CVA stuff, you don't really need to collect the studious data. All you need is just some kind of a change in how regulators accept or not accept this. If you can find such a change in regulation through your period, either in Europe or in US, you can do what corporate finance people would do, like some kind of nice difference, and that would be like cool.
No, that's true. But actually, we talked to many regulators. I talked to regulators at ECB, and none of them want to tell us. None of them want to go on record with anything. So but what they did tell me is that indeed they would view it as very strange if somebody came along and said, I'm hedging my bond portfolio with equity options, but on the other hand, they will view it as much more. They will accept as a risk mitigating trade a credit default swap option to hedge a bond portfolio. So I think they have in mind some segmentation of these two markets, and they really don't have in mind the contingent claim model, which I find interesting. I'm trying to find in the paper this nice picture we have on the CVA risk, but I don't find it. So anyways, I don't want to waste your time, but I think the idea of that picture was just to say, it was a bit like Neil's comment, which is there at least scope that this demand could be big enough to, right? If there's like 5 banks that do 100 million trade each, then that can't drive such a big wedge. But if there is, all the banks and their joint demand for CVA hedging is is in the hundreds of billions of dollars, that's different, right? And so what we find indeed is that the demand that we can infer from their statements seem to be quite large. But we don't know, of course, what fraction of that CVA hedging is done with CDX option as opposed to with something else. Maybe they just do credit default swap, they do CDX outright. There's many other ways that they could do it, and so we don't actually have it broken down. But getting a change in regulation would be great. If we could get, okay, from that point on they accepted it or not, would be great.
Or to accept that previously they accepted it as X and now we accept it as 2X.
Right.
Or at least you can show with your high frequency data that most of the trades are actually buys for those call options.
Mm-hmm.
So people are just mostly buying and not selling.
I mean, it was interesting to get this this comment from the person that was on that seemed to be a practitioner. And, we also hear that there seems to be one-sided demand, that it's the same.
Well, you have the data.
It's right. It's hard to test.
Instead of speculating, you can just go and check it. Anyway, it was fun.
All right. Great. Thanks you very much.